I'm Charlotte McLeod with investingnews.com, and here today with me is Alain Corbani, head of mining at Montbleu Finance and manager of the Global Gold and Precious Fund. Thank you so much for being here. Great to have you as always.
Thank you very much, Charlotte. Each time we meet, it's a nice recap. So I'm more than happy to go through what happened in 2025, and of course, what we expect to see in the short term, 26, at least 26, maybe 27.
Yes, that's exactly what I was thinking we would do today. Typically, we have these conversations once a year at this time. And I was looking back to the conversation we had a year ago. We were still talking about $3,000 gold. You laid out the path on how gold could get to 3,000. Of course, it got there in 2025 and well beyond. So let's take a look back at last year and what was behind gold's strong outperformance.
We've always said that gold was cyclical. We always said that the two most coherent corroboration with the price of gold are real rates and the US dollar. And we've been saying for a while that at least since 2022 that rates were going lower and that the US dollar was going to weaken. So those main points haven't changed. It's almost boring to repeat them when we are asked the question and when we want to hear investors want to hear our scenario. But the theme is the same, except that we had some new factors which made the appetite for gold and silver stronger, and these are fundamental reasons. We're going to go through them if you want, but they helped trigger more interest, more demand for gold and silver and the other precious metals. But gold went up by 65%. If we have to run the numbers, gold was up by 65%, silver by almost 150%. And you read in the news that this was the best year ever for gold since 1979, and this is true. And this is true. I'm not going to debate this fact, but when we reach a point where there's no consensus on interest rates and the direction on interest rates, and still when there is no consensus on the US dollar, and when you add the consequences of the war between Russia and Ukraine and the triggering more demand from central banks for gold, when you see the deficits climbing, when you see the debt reaching some exponential levels, all these added together make you say what I never thought I would say to an investor that in my 30 plus years of career, is that this time is different. And the fact that for me to make such a huge statement, this time is different, it means when you know my profile of being very, very conservative, investing in the sector, knowing how volatile it is, well, it makes you wonder. So in August of this year, I was making a presentation to a client, an institutional client, and we ended up, I didn't know whether he was convinced or not by my presentation, but at the end, we stood up. He led me to another room where we had a coffee, and I told him, you know what? I hate saying this, but this time is different. This time is different, and it's true that we cannot and should not only look at it as a cycle. It's much more than a cycle, and yes, Gold had an outstanding performance in 2025, up 65%, not seen in more than 40 years. But if you look at history, you know for a fact that gold did perform better than just what we saw in 2025 in some specific instances. And this is what I think we have to look at. We have to look at the big picture. And the big picture is, and I will let you ask me more questions, but the big picture is, when you have the tightening of the central bank, moving to a pause, moving to lowering rates, and we are in that phase of lowering rates, then what follows is quantitative easing. And we are exactly, the chairman of the Fed said it in December and acknowledged the fact that it was a little early to do it, and he was himself shocked and surprised to do it so early versus what they were expecting. And this is why you had a new round of appetite for our demand for gold. It's because we moved not only towards that phase of lower rates, but we also started that quantitative easing. And when you start quantitative easing, usually it favors definitely an asset like gold or precious metals in general. And silver followed up. And silver followed up because it follows, well, the correlation is extremely high. And from a gold to silver ratio of 100, we went down to 60 today, or something like this, 58, 59. And if gold is going to go higher, which we think it is going to go higher, well, suddenly you should definitely see silver catching up. And silver catching up doesn't mean only silver performing as well as gold. And a lot of investors are saying what I'm saying, but reaching that extreme level, ratio level of 40 gold to silver would mean technically that silver could go to $200, assuming that gold goes to 5,000. But we believe that gold is probably going to go beyond $5,000 the ounce.
Great recap of gold and silver in 2025. And we have so many directions that we can go in. So for you to recap a little, rates and US dollar, most important for gold. Plus now we have all these additional factors that you were going through. I wanted to start by talking about rates because we're in kind of an interesting situation where we have President Trump has said he wants lower rates. Jerome Powell's term is expiring in May of this year. So we're in a situation where probably somebody will come in who's more amenable to what Trump would like to do. So what do you see coming for interest rates in the US this coming year?
Since the summer of 2022, we have kept, we maintain our objective of equilibrium levels for Fed fund rates around 2.5%. We're at 3.6, 3.7. Basically, we do think that before we get to any other lower level, we have to reach that 2.35% Fed fund rates. And we are heading in that direction. But there is no consensus for that. And this is why I do believe that gold can go much higher, because the price of gold today does not incorporate the conviction that rates are going to go much lower than what they are at present time. So that's one. What we think is that the only way for the executive, the American executive, the only way to extend the cycle, the growth cycle, the only way is to lower interest rates. So you will have, as you mentioned, the President of the United States who wants lower rates, but you will have the next chairman of the Fed who will not only believe that the economy needs lower rates, but will basically follow the instructions of the executive, and you also have the Treasury, which basically also wants lower rates. So I don't understand why it's so complicated to accept that what the three biggest actors in that field want and will implement. So to us, it's obvious, it's clear, we're heading toward lower rates. And with lower rates, you will have a lower currency, not only because of the debasement, but also because this is the only way. I mean, if you have to pick one tool, just one tool to create growth in a weakening economy, it's the use of the currency. The best weapon or tool to trigger more growth is the currency, and the Fed, the Treasury, and Donald Trump, they know it very well. So we will have a lower currency, not only because other institutional actors want to be exposed to fewer dollars, but also because that's the only way for the American government to trigger or to maintain the growth in the economy.
So lower rates in 2026, weaker US dollar. I'm wondering if you can talk a little bit more about the quantitative easing situation, because when this news came, I know a lot of people looked at it and they said, well, it's not quite quantitative easing, but essentially it is. So can you talk a little bit more about how you see it?
Well, again, I don't see why there is a debate about whether it is quantitative easing or not. The Fed stopped buying a few months ago, and now is basically in the mode of basically buying up to $40 billion of treasury bills every month. And they mentioned, it's true that they mentioned that for now that program is supposed to last until April of 2026, but let's meet two months down the road or 3 months, and you will probably understand that it's not only a 5 months or 4 months program of buying back treasury bills and building again, growing the balance sheet of the Federal Reserve, but it will last much longer. So quantitative easing is a natural outcome of a pause in interest rates. This is the nature of the economy. You have cycles, and we are in that phase of the cycle where we need to lower interest rates. We need to lower interest rates to get some growth and help the real estate market and help the consumers and help demand basically to maintain a level of growth. And to do that, we need to lower interest rates. But since nobody really knows where we're heading on the inflation front, it's confusing everybody. But again, the Fed, the Treasury, and the White House want lower rates. You would be a fool not to think that this is the direction they are taking. I'm not talking about the labor market, of course, which is in limbo. So limbo is maybe exaggerated, but you have a lot of pockets within that labor market that are extremely weak. So and it keeps deteriorating. It has been deteriorating for the last 2.5 years, and for the last 3 to 4 months, the Fed had decided to approach this topic, and is indeed recognizing that the labor market could be a problem in 2026. So and you have the midterm elections, and you have some promises that were thrown at the voters in the previous campaign. So the whole picture makes a lot of sense that we need lower rates. We will get lower rates, and regardless of the inflation numbers, regardless. And if that's the case, and if the inflation, which we don't believe is going to be to stay at these levels north of 2%, well, it will be good for interest rates, for real interest rates, and therefore for gold. So a little bit of inflation and lower rates is the jackpot for gold. The US currency is going to follow suit. Usually between the end of the quantitative tightening and the end of the quantitative easing, usually gold doubles or triples, which means that in a perfect world, gold could go from $4,000 to $6,000. This is basically the bulk figure. So that's why when we say $5,000, that's only 10% more than what we are trading at today. It's really not only far-fetched, but it's very much in a realistic target.
And 5,000, is that a gold target for 2026, or is that longer term?
No. It's for the very short term. So give it a few months, and the market will understand that, will compromise on that non-consensual approach to the direction of rates. And it's and we need time, and this is normal, and we need that time to position ourselves. So let's not be impatient. Let the flow go, and the data will definitely demonstrate that we are in that environment where a lot of actors want to reduce their exposure to treasury bills, international actors, where the fiscal policy is going to reach its limits, and the only way again to extend that economic cycle will be to lower rates. That's the scenario we've been discussing with our clients for the last 2.5 years, and we're not changing it by a comma.
Right. So if we put all of these factors together, what is your overall outlook for the US economy? I think every year I ask you, are we going into a recession? What's going on there? You mentioned we've got higher inflation, labor market not looking so good. What's your view there?
I think that there's a huge dichotomy between what the official data are showing, which is an economy that is very resilient, and a lot of pockets of that economy that are extremely weak. And when you know that a very marginal portion of the population is responsible for this growth, it makes a lot of sense to make the statement that the economy is not doing well. But if you look at the number, you think, okay, we're in a perfect world where hyperinflation or a high level of inflation has been fought successfully, and we have an economy that is still north of the 2.5%, and this is. Frankly, this is wonderful, but the reality is that a lot of people are suffering. So, and these people are not consuming. So, with this world is full of anxiety-induced information, and. So we mentioned the debt level. We mentioned the labor market. We mentioned all these wars around us, and AI affecting we don't know how will be affecting us in a way that we have probably not figured out yet. So a lot of questions, a lot of doubts, and a lot of imbalances. And when you have all this, to answer your question, only a very aggressive monetary policy will be able, could hopefully prevent a recession. But a cycle is a cycle, and I don't believe that we will avoid a slowdown of the economy. It's the same. I won't say that this time is different, because an economic cycle is an economic cycle. But for gold, it's different because of all those layers that are being added to what the negative correlation with real rates and the dollar are represent for the price of gold.
Yeah, I understand what you're saying there. And I also want to check in with you on the stock market in the US, because there's been all these concerns about AI bubble. The upward momentum has continued for too long. Do you see a correction there coming as well as we're moving forward?
I think that a 10%, 15% correction would be healthy. But I think that as long, and don't forget that the market is forward looking. So as long as we are going to give the market what he wants, basically lower rates, lower taxes, and we're heading there. And the impact on earnings. I mean, right now, everybody's throwing earnings growth in the north of the double digit. So why wouldn't, so even though I would like to see a healthy correction, frankly, Warren, we might not get it. We might not get it because if we have this fiscal regime and this monetary policy impacting the fundamentals of the companies, publicly listed companies, well, in that case, that bull market could last at least another year, very much so. So I want to be on the defense, but I recognize that the language that is being used is used in a very, very smart way to reassure the investors. And that's why very few institutional investors have cash. They are, most of them, fully invested. So, again, this is a contrarian indicator, but if the earnings are growing, the logic would be for the equity market to continue performing well.
I want to ask you about gold stocks as well, because again, if I look back to our conversation we had a year ago, we were still waiting for gold stocks to start taking the higher gold price into account in their results. And obviously now that has happened. So for you, when you look at gold stocks, you're thinking that the gold price is going to go higher. Where are you seeing the most opportunity in the equities?
Very good question. It's so that second part of the bull cycle is always dedicated to the theme of growth. And we will see more appetite for deposits that are not in production, or that are fundamentally decent, but mismanaged. And I think that you want to be positioned in companies that have one of these attributes that are not priced by the market. So this is what we are trying to do. Yes, we own the Barricks and the Newmont, but we also own some names that are not covered by most of the brokerage houses, and and based to give you an idea, 70% of the fund is invested in non-indexed names. So we are trying to go where either there is a producer that could make significant changes to its profitability, all things being equal, so with a flat gold price, or identifying deposits which have the qualities to become a mine and are under the radar. So now that I told you this, I would definitely look at the explorers, the developers, because they still are the future in that second part of the bull cycle. So, but once I said this, if when gold goes north of $5,000, the balance sheets of the gold miners, the producers, is going to be phenomenal. It is already outstanding. So, so there will be a lot of cash, and this cash will be used for buybacks, like it's done presently, which is a smart way to do it. But we shouldn't be doing it too long, and we are investing in the future, in growth, and this is what you want to see. So the minute you're going to see a company making an acquisition that is accretive, it's very important, it has to be accretive, it will be rewarded. A deposit that is growing in size, that is not being mined, will gain in value, and discoveries. But we shy away from, pure explorers, because there is too much, there is a very high risk reward ratio, but this is not our mandate. Our mandate is to invest in qualitative names and special situations.
So this is the approach for gold stocks. Are there any differences in how you're looking at silver stocks right now?
So as it stands now, we believe that silver could definitely outperform gold, definitely in that environment, most probably will. We do believe in that extreme gold to silver ratio of 40 that we hit once over the last 25 years. But again, this time is different. So there are too many reasons to lose faith in what could be run in the running of public money. It's unbelievable what we have achieved in the last 8 years in the destruction of public money. So again, this will have to be. We will have to respond to this, and the only way will be a monetary approach, and the monetary approach is favoring precious metals. So that's how I see it. Silver, yes. Silver names, yes. I would definitely. All the silver deposits are known. All the which are not in production are known. So it's all about finding the less expensive, the most rewarding names, whether it's through discoveries of the increasing the size of the asset, or obviously by as a takeover candidates. But it's going to be hard to find more silver deposits. Very hard. It's going to be very hard.
I think I understand what you're saying there when it comes to gold versus silver. And just one more follow-up question on silver. I was wondering, so the short-term price target for gold, 5,000, do you have a price target or range in mind for silver in the short term or the longer term?
No, longer term, in that environment, gold needs to go beyond 5,000 for silver to go beyond 150. Okay, let's be very clear. But so there is no frost Basically, what I'm trying to say is that there is no frost yet. I don't see the frost in that market, which is very reassuring. And this is why we are very comfortable saying that there is much their potential for reaching new highs, historic highs, is very, very significant. So as long as I don't see the frost, I'm not worried. And my targets can increase naturally because there is no speculation. You had the last 2 weeks of the year some speculation and repositioning and arbitrage. This is noise. Let's forget this. But if we focus on the bigger picture, there is no frost. And I mean, look at the number of shares outstanding in the ETFs. They are 20 or 30% below their peak. I mean, it's still unbelievable when silver is at almost 80 and gold's at 4,500. So there is no frost. There is no appetite for the gold miners, and they are building cash like crazy. So I will start being very concerned and will change my statements scenario when I see that speculation coming, and I haven't seen it yet. So are we going to have hiccups? Of course we're going to have hiccups. Are we going to need time to digest a 25-30% run in the precious metal? Of course we will need time to digest it, but the trend is still intact for us to reach higher levels.
Well said. So focus on big picture. Don't pay attention to the noise. Before I let you go, I think it's been a great overview, but any final thoughts you'd share on the precious metals?
Well, it's this. Your question reminds me of a meeting I had with the executives of a mining company, and I told them that I was basically going to invest in them because I saw huge potential in catch up revaluations, and I never say this, but it was so obvious to me. So the same way I told them that I believed in their strategy and their execution, and that their price didn't incorporate those the talents that I had recognized. The same way I will tell you that as long as there is no consensus on rates or the dollars, as long as there is no an excessive speculation in the sector, and those mining companies paying ridiculous prices for marginal assets that will never come to life, then you will hear me have a different speech. The same way, and I will finish by saying that I've always told our investors, our clients, that usually gold miners, that it's the end of the cycle when those gold miners reach a peak of profitability in the 25-30%. I've always told them that, and I've always told them that we need to sit down around the table when we reach those levels, so that we discuss whether there are new elements that convince us that there is more upside potential or not. And today we are at this juncture, and I'm sitting down with them, and we are discussing open discussions, but we all have come up to the conclusion that the upside is still significant, and we are sticking to our scenario, at least for 26 and maybe 27.
Well, I think that's a really nice place to wrap up. Thank you so much for coming on to share your thoughts about gold and silver. It's always great to have you on right at the beginning of the year.
Thank you very much, Charlotte. Always a pleasure.
Of course. And once again, I'm Charlotte McLeod with investingnews.com, and this is Alain Corbani with Montbleu Finance. Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel.
We'd also love to hear your thoughts, so leave us a comment below.